What are the main points and violations regarding RESPA and CFPB? Real estate agents should be aware of several key CFPB rules that impact real estate transactions, especially those involving financing. Here are the most important ones. TILA RESPA Integrated Disclosure. Rule what it does. Merge the Truth in Lending Act, TILA, and Real Estate Settlement Procedures Act, RESPA. Disclosures into two forms. Loan estimate, LE, given within 3 business days of a loan application. Closing disclosure, CD, must be provided at least 3 business days before closing. Aims to increase transparency in mortgage transactions. Why it matters for agents. Delays can occur if changes happen within the 3-day window before closing. Agents should work closely with lenders to ensure buyers receive the required disclosures on time to avoid last-minute closing issues. RESPA, Real Estate Settlement Procedures Act. Anti-kickback rules. What it does. Prohibits kickbacks, referral fees, or unearned fees between real estate agents, lenders, title companies, and settlement service providers. Prevents inflated costs for consumers due to behind-the-scenes financial agreements. Why it matters for agents. Agents cannot accept payments, gifts, or incentives from lenders, title companies, or home warranty companies in exchange for referrals. Legitimate marketing services agreements, MSAs, must comply with CFPB guidelines and be carefully structured to avoid violations. Fair Lending and Equal Credit Opportunity Act, ECOA. What it does. Prohibits discrimination in lending based on race, color, religion, national origin, sex, marital status, age, or income source. Why it matters for agents. While this applies mainly to lenders, agents should avoid steering buyers toward or away from certain lenders or neighborhoods based on protected characteristics. Be aware that buyers cannot be denied financing unfairly due to personal characteristics. CFPB advertising and marketing rules. What it does. Requires truthful advertising and prohibits misleading claims in mortgage and real estate marketing. Ensures that all fees, terms, and loan conditions are accurately disclosed. Why it matters for agents. Be careful when advertising mortgage rates, payment estimates, or lender partnerships. Avoid using language that misrepresents loan approvals or financing terms. CFPB complaint process and enforcement. What it does. CFPB investigates consumer complaints related to mortgages, credit, and lending practices, can impose significant fines and penalties for violations. Why it matters for agents. Be aware that clients can file complaints with the CFPB about lenders, agents, or settlement services. Working with reputable lenders and settlement providers can help prevent legal issues. Key takeaways for agents. Stay informed about TRID timelines to avoid closing delays. Do not accept kickbacks or illegal referral fees. Avoid discriminatory practices in lending recommendations. Be truthful in all advertising related to mortgage and financing. Educate clients about their rights under CFPB regulations. RESPA, Real Estate Settlement Procedures Act, Overview. The Real Estate Settlement Procedures Act, RESPA, is a federal law enacted in 1974 to protect consumers in real estate transactions by ensuring transparency, fairness, and eliminating kickbacks in mortgage and settlement services. It is enforced by the Consumer Financial Protection Bureau, CFPB. Key RESPA rules. Real estate agents should know prohibition of kickbacks and referral fees. Paragraph 8. What it means. Agents cannot receive or give kickbacks, referral fees, or anything of value in exchange for referring business to a mortgage lender, title company, or other settlement service provider. Examples of illegal kickbacks. A lender pays an agent $100 per client referral. A title company gives an agent free marketing materials in exchange for referrals. A home warranty company offers a gift card to an agent for recommending their services. What's allowed? Marketing service agreements, MSAs. If structured properly, agents can enter into agreements where they are paid for actual services rendered, e.g., advertising, open house sponsorships. Affiliated business arrangements, ABAs. If an agent has ownership in a title company, lender, or other service provider, they must disclose this relationship in writing to the client. Required disclosures. What it means. RESPA requires certain disclosures to be provided to buyers and borrowers to ensure transparency. Key disclosures. Loan estimate, LE, given within 3 business days of applying for a mortgage. Closing disclosure, CD, given at least 3 days before closing to outline all costs. Affiliated business arrangement, FBA. Disclosure. Required, if an agent refers a client to a company they have a financial interest in. Mortgage servicing disclosure informs borrowers about how their loan will be serviced. Limits on escrow accounts. What it means. Lenders cannot require excessive escrow deposits for property taxes and insurance. RESPA caps the amount a lender can require in an escrow account. Prohibition of unnecessary fees, junk fees. What it means. Lenders and settlement service providers cannot charge excessive or hidden fees for services that do not benefit the consumer. Examples of junk fees: duplicate or excessive loan processing fees, inflated administrative fees. How RESPA impacts real estate agents. Avoid illegal kickbacks and referral fees. Disclose any financial interest in a service provider, FBA. Educate clients about required mortgage disclosures. Work with reputable lenders who follow RESPA guidelines. Scenario of a RESPA violation. Situation. Sarah is a real estate agent working with first-time homebuyers. She has a strong relationship with XYZ Title Company, which she frequently refers her clients to for closing services. The violation. To show appreciation for the referrals, XYZ Title Company gives Sarah a $200 gift card for every client she sends their way, free marketing materials and advertising space on their website, invites to exclusive events, luxury dinners, sporting events, etc., in exchange for continued referrals. Why this violates RESPA. Illegal kickbacks and referral fees. Paragraph 8 of RESPA. Sarah is receiving a thing of value, money, gifts, free marketing, in exchange for client referrals, which is prohibited. Failure to disclose affiliated business arrangement, FBA. If Sarah has a financial interest in XYZ Title and doesn't disclose it in writing to her clients, she violates RESPA. Consequences. The CFPB could fine Sarah and XYZ Title up to $10,000 per violation and impose triple damages on affected consumers. Sarah could face criminal penalties, up to 1 year in jail. Her real estate license could be in jeopardy due to ethical violations. Penalties for violating RESPA. Criminal penalties. Fines up to $10,000 per violation and up to 1 year in prison. Civil penalties. Triple the amount of any kickback or referral fee received. CFPB enforcement. The CFPB actively investigates and penalizes violations. Scenario of a CFPB violation situation. John is a mortgage lender who works closely with a group of real estate agents in his area. He wants to ensure that agents consistently send him business, so he develops a strategy to increase referrals. The violation. To encourage referrals, John misleads borrowers about loan terms. His advertisements claim guaranteed lowest interest rates and no fees. But in reality, borrowers end up paying higher closing costs. Pays agents for referrals. John gives a $500 bonus to any real estate agent who sends a client his way. Delays providing the closing disclosure, CD. He intentionally waits until 1 day before closing to give the borrower their final disclosure, preventing them from shopping around or questioning unexpected fees. Why this violates CFPB rules. Misleading advertising, TILA and MAP rule violation. The Truth in Lending Act, TILA, and the Mortgage Acts and Practices, MAP rule, prohibit false or deceptive advertising in mortgage lending. John's ad misleads borrowers into thinking they will get a better deal than they actually receive. Illegal kickbacks, RESPA Paragraph 8 violation. The Real Estate Settlement Procedures Act, RESPA, forbids lenders from paying real estate agents for referrals. The $500 per referral is a clear kickback. Failure to follow TRID, TILA, RESPA Integrated Disclosure Rule. Rules. The closing disclosure must be provided at least 3 business days before closing. By delaying the disclosure, John is violating CFPB mortgage disclosure regulations. Consequences. CFPB fines can reach millions of dollars for deceptive lending and kickback violations. John could lose his mortgage license and face legal action. Borrowers affected by his misleading ads could sue him for damages. The CFPB could order consumer refunds for any excess fees or costs that were unfairly charged. How to stay compliant. No false advertising. Be honest and transparent in all marketing. No referral payments. Agents and lenders should not exchange money, gifts, or incentives for referrals. Follow TRID timelines. Loan estimates and closing disclosures must be provided on time to allow borrowers to review costs. A little more on the subject. TILA, Truth in Lending Act, and CFPB, Consumer Financial Protection Bureau, are governed by federal laws that regulate lending practices and protect consumers from deceptive and unfair financial practices. Laws regarding TILA, Truth in Lending Act. TILA is a federal law enacted in 1968, 15 U.S.C. paragraph 1601 ETSEQ, which requires lenders to disclose key loan terms to borrowers. It aims to promote transparency in consumer credit transactions. Key TILA regulations. Loan disclosure requirements. Lenders must provide clear, standardized disclosures about interest rates, APR, loan terms, fees, and payment schedules before a borrower commits to a loan. Right of rescission, 15 U.S.C., paragraph 1635. Borrowers have 3 days to cancel certain mortgage loans without penalty. Limitations on high-cost loans under the Home Ownership and Equity Protection Act, HOPA. Amendment, TILA restricts predatory lending practices such as balloon payments and excessive fees on high-cost loans. Regulation Z, 12 CFR Part 1026. Implemented by the CFPB, this regulation enforces TILA's rules on credit card issuers, mortgage lenders, and other credit providers. Mortgage servicing rules. Lenders must provide monthly mortgage statements, disclose rate adjustments on adjustable rate mortgages, ARMs, and ensure accurate application of payments. Laws regarding the CFPB, Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau, CFPB, was created under the Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010, to regulate financial institutions and enforce consumer protection laws. Key CFPB regulations and laws. Enforcement of TILA and RESPA. The CFPB enforces both TILA and RESPA, Real Estate Settlement Procedures Act, to ensure fair lending practices and full disclosure in mortgage transactions. The Ability to Repay Rule, ATR-QM Rule. Under Dodd-Frank, lenders must verify a borrower's ability to repay before issuing a mortgage loan. This prevents risky subprime lending. Mortgage servicing and foreclosure protections. CFPB rules require lenders to follow specific procedures before foreclosing on a property, including offering loan modifications and loss mitigation options. Prohibition of unfair, deceptive, or abusive acts, UDAAP. Lenders cannot engage in deceptive marketing, hidden fees, or unfair loan terms. The CFPB investigates and penalizes lenders for violations. Regulation X, 12 CFR Part 1024, covers protections under RESPA, requiring lenders to provide good faith estimates of closing costs and preventing illegal kickbacks between mortgage service providers. Regulation F, Debt Collection Rule, protects consumers from aggressive debt collection practices and limits how lenders and collection agencies can communicate with borrowers. How these laws protect borrowers: ensures transparency in loan terms and costs, protects borrowers from predatory lending and deceptive fees, grants consumers the right to dispute unfair lending practices, requires lenders to assess a borrower's ability to repay, prohibits aggressive foreclosure practices and misleading loan servicing,